Welcome to the B.F. Anderson Technical Report for December the 23rd. I want to wish everyone a Merry Christmas and a Happy New Year. And hopefully next year the market has a good year. 2020 was a very easy year for growth stocks. It was a good year. Everything went well. This 21's been difficult. I'll be frank with you. The growth stocks didn't perform as well as the prior year. But it's very rare to get 2 years in a row, but sometimes it's happened. It's only happened to me once and 30 plus years, and it's a rare event. So let's get right into what's going on right now. As you can see here with the NASDAQ, we peaked, we rolled over, continuing in a downtrend. Even though we're getting some of these what we call dead cat bounces, I still would be very cautious here. Now, you don't want to get too bearish because you can see here on this long-term indicator, which is the 35-week, we continue to stay in an uptrend. This is really, I will continue to say, one of our better indicators along with the S&P. And again, the rule is we break below the 35-week for 2 weeks, then I'll have to change my mind about where we are. But right now, we're still in a bull market. Mid-cap, same thing, rollover, not making a new high, looking iffy. New York Stock Exchange, all the stocks on the New York Stock Exchange, same thing, kind of looking, sideways at best. Small caps really been getting hammered here. They broke below the 200-day, came down really hard. Somewhat of a bounce, but just not an uptrend. It's just not in an uptrend. Here we have the S&P 500, which is really holding up the best, especially if we look at the long-term indicator. Again, 2 weeks below that line, but we're not getting it, so we're still in a bull market. Now, on the aggression index, we got the sell signal about 2 weeks ago. However, we're starting to get a bounce here, so that might be an indication that maybe we've made a low here in the growth stocks. On the the three economic indicators, you can see here with interest rates, we continue just to move sideways. Oil down, sideways. Financial stocks down, sideways. So not much to see there. Now, on new lows, we got a bunch of elevated new lows during this correction. We're starting to settle down a little bit, but we're still not below 40, continuing to monitor this indicator. When we get to sentiment, the AAII bull-bear ratio is in a negative zone, which means fear, which is good. We don't want a bunch of greed going on here. We could work ourselves all the way down to here, but just be aware of it. Now, on the put-call ratio, I decided to make a change on that. It's such a hard indicator to read, to be frank with you. So what I did is I just took using my eye, I just took the middle ground and said, okay, if we're above that middle ground, that's fear. Below the middle ground, that's fear. This is greed, greed, fear. And we've pulled back into greed a little bit, but the indicator is actually improving along with that AAII bull-bear ratio. Now, also, I made another change. I went and talked with a good banker, a good friend. He's a banker, retired banker. We talked about the yield curve and how important it is to understand why the yield curve is important. So what I did is I took the 3-month Treasury bill compared to the 5-year Treasury note. Now, why am I doing that? Bankers tend to lend, their cost of funds, meaning deposits, tend to be short term. But then their costs are short term, meaning they're not paying anything for them. And then they'll lend at a longer rate, and I would think the 5 years. So the purpose of this particular indicator is to try to really determine if credit is going to dry up, because if you get into an inverted situation, the bankers are going to quit lending because they can't make any money. So we'll just keep an eye on the yield curve. So far, it looks okay. Realize that the spread between the 3-month and the 5 year is only 1.17, and we have seen it, as high as up here around 2.8, 2.9. So it's kind of in the middle ground. Now, the other thing my banker friend explained to me was don't forget about default risk, because the bankers, they also make most of their money on the credit cards, but then they've got a lot of default risk. So as the junk bond market continues to deteriorate, that's just simply telling you that the default rate is not improving. It's actually increasing, but we came down, made a low, somewhat stabilized. Volatility index, we're seeing, the VIX get back down into somewhat of a normal zone here, so volatility has somewhat cooled off. Now, I wanted to mention these particular ETFs just to show where the action is right now. Consumer staples, which has a lot to do with the aggression index that we talked about earlier. The consumer staples continue to be kind of the leadership here. Now, realize what's happening is a lot of these large institutional investors can't go to cash as well as a small investor can, like us. So what they do is they run to things like consumer staples. I'm talking toilet paper, toothpaste, that kind of thing. So it's the sign that this is in an uptrend kind of tells you that they are getting defensive. Same thing for like electric utilities and utility stocks. Same kind of pattern. Here we have healthcare stocks, which is big pharma. This is basically they're hiding. They're hiding here. Now, I also wanted to mention here the percent of stocks on the NASDAQ that are above their 200-day moving average. And I mentioned that the 25% area was important. So I went back about 20 years and just kind of looked at it. And you notice here, if it breaks through 25, in this particular case, it got down to a reading of about 10, meaning 90% of the stocks were below the 200-day. Now, here's the 09-08 financial crisis. We got down to 5 once we broke below 25. So we're holding the 25 so far. So let's just see what happens here. Now, I did the same calculation for the New York Stock Exchange, and I just went ahead and drew it right in the middle here, and you can see when it breaks below that middle zone, it tends to go lower. So hopefully we're making a low here, but according to this indicator, we may have a little bit more to go. Now, on the top 5, we're seeing things like Alcoa, which is, we got a nice big gap up in the stock, which came 4 days ago, which was somewhat of a breakout above a pattern here. It looks pretty constructive. Here's Ambarella. This has been a tough stock to make money in. It's been in a nice uptrend, now moving sideways. I would just continue to watch Ambarella. Arista Networks, this is looking good. Now, this is all about telecom equipment used for the infrastructure of the internet, which is 5G now. You can see here we've got a nice little uptrend going above the 10-day. We actually broke out, gave a new buy signal. This was a little troubling in here where we had this big gap up and then a gap down. That was somewhat of a failed rally, but it looks like it's getting back into an uptrend. I like the stock. We own it. Marvel Tech, we had the gap up, rallied, and then we kind of what we call a round trip. It went up and it came right back down to this level. I would continue to watch Marvel. On semiconductor, we got the gap up, holding the gap, somewhat in an uptrend. If it were to break out up into this area here on exceptionally high volume, it could be interesting. So that's it. If you have any questions, let me know. Thank you.